Today, the CPI's a donut. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. The Australian Bureau of Statistics released their Consumer Price Index, the CPI series, for the March quarter of 2019, and frankly, it's a shocker. The March quarter CPI was flat at 0 compared to the market median of around 0.2%. Even at the two decimal places, the CPI was also flat at 0. And this is 0.5% below the December quarter's result. The annual rate dropped to 1.3% from 1.8%. And that's the slowest annual pace since September 2016. In addition, the 6-month annualized pace is now just 1.1% annualized using seasonally adjusted data. And that's the slowest pace since June 2016. Now, all this is highlighting that inflation continues to remain well under the bottom of the RBA's target band of somewhere between 2 and 3%. And this result underscores the lack of widespread inflationary pressure and that the current housing correction will be an ongoing dampener for core inflation ahead. And the so-called analytics series, which provides alternative measures of underlying inflation in the economy via the trimmed mean and weighted mean, and which seeks to capture the breadth of price inflation across the basket of consumer goods and services, is also off-key. The average of the RBA's core measures, which are seasonally adjusted and excludes extreme moves, rose 0.2% in the quarter, and that's below market expectations, which were for 0.4%. In the quarter, the trimmed mean gained 0.28%, while the weighted median lifted 0.1%. And the annual pace of the average of the core measures came in at 1.4%, the slowest pace of core inflation since December 2016. In fact, incorporating revisions, the 6th-month annualized growth core inflation is now just 1.2%, well below the bottom of the RBA target's band of 2 to 3%, and the slowest pace since December 1997. Looking at the major components, quarterly prices rose across 4 segments, fell across 6, and was flat across 1. Food rose 1.3% versus a 1.1% expectation, with drought and adverse weather conditions continuing to reduce the supply of a selection of fruit and vegetables, adding to high input costs and placing upward pressure on other food items such as poultry and bread. Clothing and footwear fell 1.4%, compared with down 2% as forecast. And tobacco prices surprised with a 0.7% fall. Housing was flat on falling house prices and utilities. And household contents fell 0.4%, health rose 1.9%, and recreation fell 1.5% due to a larger than expected fall in holiday travel. The softer than expected housing cost data reflects the fall in dwelling prices, down 0.2%, and this in turn reflects a significant fall in Victorian dwelling prices of 1.2% down, and rents reported a modest 0.1% rise, while utilities surprised with a 0.1% fall. New South Wales continues to worry, with a significant near-term negative risk around dwelling purchase prices, and prices are already falling in Victoria, as are rents in New South Wales. And given that rents and dwelling purchases together are worth around 15% of the CPI, this is a significant risk for headline inflation, and even more so for core, where the weight is somewhat higher. Overall, housing has a significant group weighting in the CPI of 22%, so it has a meaningful impact on both inflation and core inflation. And with such a modest outlook for housing costs, it is unlikely that we're going to see any meaningful acceleration in core inflation from below the bottom of the RBA's target band. And over the year, prices rose in 8 out of 11 key components and fell across 3. And we should also look at the tradables, mostly imports, and non-tradables, mostly services. Here, tradable inflation, which is around 40% of the CPI basket, has been held down over the past decade and more by the higher Australian dollar and cheaper goods from China. Both tradable and non-tradable inflation has also moderated recently. Tradables fell 0.6% in the March quarter, and tradable goods fell 0.6% due to automotive fuel down 8.7%. Tradable services fell 2% due to international holidays, travel and accommodation down 2.1%, and non-tradables rose 0.3% in the March quarter. Non-tradable goods rose 0.4% due to pharmaceutical products at 5% up, and the non-tradable services component rose 0.3% due to secondary education up 4.2%. It was hard to find even some isolated inflationary pressures. Even tobacco prices surprised with a fall in the quarter, and clothing and footwear may not have fallen as much as expected, but they're not a galloping inflationary pulse either. So in summary, inflation is stuck well below the target band, with little reason to expect it to return there anytime soon. And this is because of structural issues in the domestic economy, as we've been highlighting, which include weak wages growth, high levels of employment underutilization, and considerable excess capacity in the economy. After the results came out, the Aussie fell on the prospect of more immediate rate cuts, although we suspect the RBA will continue to follow the employment trends, and that will be a trigger for a cut if it rises. On the other hand, the stock market went higher, to a peak not seen since 2007 before the GFC. And this is because lower rates means inflated asset values and possibly QE later. But the probability of a rate cut during the election campaign just went up. We are, economically speaking, in the doo-doo. And to underscore this, the yield spreads between the US and Australia 10-year bonds widened to 76 basis points, and that's the widest spread observed since the 1980s, as it continues to inch further in favour of treasuries since the turnaround last year. The Aussie dollar US dollar has largely been dominated by the yield story since the second half of 2017. And with the RBA set to cut its cash rate in the coming months, it's going to keep this narrative in play after several months of pause, as the Fed is in a wait-and-see mode currently. And if you're wondering why traders continue to favour the dollar despite the weakening fundamentals in the US, it's because elsewhere, everything else is much worse. And the Australian economy is just one example of it. Beyond that, in the UK, there's Brexit worries still ongoing. In Europe, economic conditions are deteriorating rapidly in Germany, and political risks still remain present throughout Italy. And in Australia and New Zealand, central banks have one foot in the rate cut circle already, and with yield differentials like we're now seeing, it will continue to keep the dollar attractive to spot currency traders for quite a while yet. That is, until the Fed decidedly gets on the rate cut bandwagon too. And I think that is coming at some point, but not yet. I'm Martin North from Digital Finance Analytics. Thanks for watching, and I'll talk to you again next time.